Bitcoin's been decelerating from 120% a year growth to 100% growth to 80%. It was clocking at 80, 90% when I got into it. It's been about 55 to 60% for the past 5 years. If you look at the rate, my forecast is it decelerates from 55% ARR down to 20% ARR over 20 years. Why is it decelerating? Well, obviously for the law of large numbers, when you've got $100 trillion asset, you're not going to grow 80% at that level. It's decelerating because it's merging with the capital markets, and as it merges with the capital markets, then there's less and less money. It's harder. It's harder. I mean, anybody knows $1 million company can grow faster than $1 billion company, which can grow faster than a $10 billion company, which can grow faster than $100 billion company, which can grow faster than $1 trillion company, which can go faster than a $10 trillion company, which can grow faster than a $100 trillion company, right? Not complicated. It's simply the law of large numbers and math.
Michael Saylor isn't just making predictions, he's redefining how we measure risk in finance. In this sweeping vision of Bitcoin's future, he doesn't shy away from volatility, but instead reframes it as part of a larger, inevitable transformation. While critics often argue Bitcoin is speculative, Saylor flips the script. Bitcoin, in his view, may actually be less risky than traditional stocks over time. And not just less risky, more functional, more global, and more reliable.
Bitcoin will outperform the S&P index. And I think it's very simple as to why it will outperform the S&P index. It doesn't have the counterparty risk of corporate structures, and it doesn't have currency exposure, right? So the S&P is saddled with a huge amount of corporate risk factors, dozens and dozens of them, tariff, supply chain, etc. It's got legal risk, it's got political risk, it's got physical risk.
He makes the argument clear. Every stock in the S&P 500 is tied to geography, government policy, physical infrastructure, and management, each a point of potential failure. Bitcoin, however, operates outside those constraints. It's a neutral protocol, borderless and incorruptible. In Saylor's world, the fewer entanglements an asset has, the more stable it ultimately becomes in a volatile macroeconomic landscape.
If I strip away the physical risk, and if I strip away the political risk, and if I strip away the management risk, and then every company takes in cash flows and pesos and naira and euros and CNY and rubles and dollars and Canadian currency and AUD and whatever. So when you strip away all of those risk factors and keep the pure capital, you've got Bitcoin. So whatever those things are, Bitcoin will be more than that.
Saylor paints a picture of capital stripped to its purest form, disconnected from jurisdiction, leadership, or fragility. Stocks may be tried and true vehicles for wealth growth, but he argues they're weighed down by too many systemic inefficiencies. Bitcoin, on the other hand, is immune to CEO scandals, embargoes, recessions in any single country, or the whims of central banks. It's as if he sees Bitcoin not just as digital money, but as the first universal asset.
You cannot go long 50x on Apple stock on Sunday morning in Iran, right? You can't, right? We could talk about why you can't, but you just can't. So you can't go long and you cannot short an equity 20x on Sunday morning. So you have all of these guardrails on equity, and they limit the leverage, they limit the utility. If I had pure capital and I could have unlimited leverage, unlimited utility anywhere in the world, 24/7, 365, there are no holidays for Bitcoin, right?
Accessibility is another weapon in Bitcoin's arsenal. Saylor emphasizes that stocks remain trapped within the 9 to 5, Monday to Friday ecosystem of legacy finance. Bitcoin, meanwhile, never sleeps. It's always liquid, always available, and increasingly integrated into global systems. In a digital world, he argues, only Bitcoin meets the needs of the digital age.
That bucket, that benchmark, which is the S&P, it's less volatile, it is less liquid, it is less useful, it is more risky, it is more diversified, and it's got some human factors in it too. I mean, the S&P board just decides what to put in it, right? Like maybe they don't maybe they don't put the right thing in. Maybe they leave something that shouldn't be in it, right?
Even the structure of the S&P is not immune to criticism. Saylor raises a crucial point. The index isn't governed by physics or math. It's managed by committees, human decisions, and sometimes political pressure. This is in direct contrast to Bitcoin's open-source, algorithmic governance, which applies uniformly and predictably, regardless of the operator.
If you're looking for a pure, objective monetary index governed by the laws of nature, the most useful type of capital asset in the world to everyone under all circumstances at all times, that's Bitcoin. So, if I were to say it ought to be twice as performant as the next best thing, that wouldn't be unreasonable.
It's a bold declaration, but one built on a framework of logic. Saylor's entire argument hinges on removing variables. The fewer the risks, the clearer the projection. If you eliminate management errors, political instability, and currency devaluation from the equation, what's left is Bitcoin, a digital standard, as predictable as gravity.
My long-term forecast is like 21% ARR and 21 vol. And I would say, the S&P will be more like 10% ARR, 15 vol. Bitcoin's going to have the higher Sharpe ratio. Bitcoin's going to have the higher vol. Bitcoin's going to have the higher performance because it's engineered and it's accessible.
While acknowledging volatility, Saylor reframes it as a feature, not a flaw. Bitcoin's sharper swings come with sharper returns, and for the long-term investor who understands how to balance risk and reward, he believes Bitcoin is the better bet, despite its reputation.
There's going to be someone in a country doing something with capital that you don't understand, that's illegal in your country, that's going to make you money, right? Right? The redneck in Arkansas with Bitcoin buried in their backyard is going to make money off of some rocket scientist in Singapore or Beijing doing something with some capital they've never heard of in a way they can't understand, that's either illegal, and they'll be doing it while the guy in Arkansas is sleeping. But the dude in Arkansas is making money.
Saylor's vision is one of interconnectedness, where global capital flows aren't limited by borders or knowledge gaps. Bitcoin becomes a network that rewards participation, even for those who don't understand its mechanics. It becomes not just a hedge, but a bridge across global innovation, decentralized finance, and even chaos. So what did we learn? According to Michael Saylor, Bitcoin isn't just a speculative play, it's an upgrade. It's a form of capital that strips away the risks and inefficiencies of corporate equities and replaces them with code, openness, and infinite accessibility. Far from a gamble, he argues Bitcoin may be the least risky place to park your wealth long-term, especially as legacy systems falter. And as he sees it, that future is already underway.
That is the basis of my assumptions about the long-term performance of Bitcoin. Obviously, it's all driven by some base rate assumptions. One base rate assumption is how fast does the money supply expand? Another base rate assumption is how rapidly does technology improve and how much productivity is driven by technology.
What do you think? Is Bitcoin truly safer than stocks? Or is Saylor too close to the flame to see the fire? Let us know in the comments below.